Hello, everyone, and again, thank you for joining us today on this rather crisp winter day, at least here in Maryland. So, of course, our webinar today is about the 2025 market outlook, and we're can believe we're getting there already. We're already at the end of the year. Where the risks are lurking, but there's certainly plenty of opportunities for us to discuss today. And actually, when I was doing the final review of the material, we certainly have a lot to discuss today. So before we get started again, for any of you who ever participated in any investment oriented webinars, I have to read you this quick disclaimer. Anything that we're about to discuss today should not be considered investment advice. The information that we're about to share with you is purely for educational and informational purposes only. And if you decide to implement anything that we're about to discuss, we strongly recommend that you do your own due diligence, or of course, reach out to qualified financial advisor to discuss your questions. Usually what I do 24 hours before we start our webinars, I look at the list of participants. And this time, in some sense, too, wasn't particularly surprising. Roughly half of the participants are our existing clients. So, of course, welcome. Great to have you with us. I'm glad you found some time to, join us. And the remaining, half are people from our network, and also some new names, perhaps people that are not familiar with me and perhaps with what we do. So for those of you who are less familiar, well, my name is Alex Selesnev. I'm a certified financial planner, chartered financial analyst. I'm the founder and president of Capital Squared Financial. We're really we're a boutique style firm that focuses on tax efficient retirement planning and investment management. And what I mean by that, to usually clarify the meaning of that, we work almost exclusively with people who are thinking about transitioning or already in retirement. And of course, their families as well. At this time, we manage just a little under 130 million for 63 clients, so individuals, families, and we also do some trust management for our clients. My business partner, Asa De Silva, he's also a chartered financial analyst. He's the chief investment officer at Capital Squared Financial. Has over 25 years of experience in investments. He started his career during the Asian financial crisis in the 90s. He worked through the dot-com debacle, for any of you who remember that. And he even helped his clients navigate the global financial crisis. So those were rather, again, challenging times for those who remember. And really, this unique experience helps us to create retirement plans that can, quickly adjust or adapt to the rapidly changing market conditions, which is, of course, what we'll be discussing today. A little bit more about our firm. As I mentioned earlier, we specialize in transitions. And of course, your eventual transition into retirement, unless you're already in retirement, will likely be one of the most important ones you'll ever make. You certainly don't want to retire for the second time. And that is our primary objective, is to make sure that you're safe and secure in retirement. We focus on individualized investment strategies, meaning that every single client we have has his or her own, custom investment strategies. There are no, cookie cutter portfolios. And we're also very proactive when it comes to tax planning. And I'll tell you, when I meet specifically with our new clients, one of the questions I like to ask, well, what do you expect to be your largest expense in retirement? And in some cases, people would think about it and they would say things such as medical expenses, but in practice, again, taxes will likely be certainly in the top 3 at the very least. So if you can minimize that, that will greatly help. We're fully independent. We're a fee-only firm. We always serve as a fiduciary when we work with our clients. And last but certainly not least, we're very responsive. That is, part of being a boutique style firm. We pretty much always respond to our clients within 24 hours. And at the very least, we acknowledge that we'll receive their requests. If you want to learn more, of course, feel free to visit our website, csqfinancial.com, or feel free to reach out to Asi or myself. We'll be glad to hear from you. Next slide, please. So for any of you who ever participated in our market updates in the past, I usually try to start with something that is, funny, or perhaps not so funny, but at least relevant in terms of where we are in the markets today. And again, there are certainly lots of concerns and opportunities at the same time. But if you really take like a big picture view, one of my primary concerns is expectations. So if you look at the markets over the past essentially 2.5 years, and specifically this year, when the S&P 500 index hit new time high for over 50 times. Now, unfortunately, and many people perhaps wouldn't even admit that, the expectation is that the markets will just continue to go up, up, and up. And then, of course, eventually that doesn't happen, right? And then we experience a rapid correction or perhaps even a recession. So the bottom line is, at this point, there's really no reason to be unprepared for that. And really, when I was preparing for this webinar, what came to mind, I don't know how many of you are familiar with Sir John Templeton. He's one of the top, investors of his time. He's in Warren Buffett's league. But what he said was the four most dangerous words in investing are, "It's different this time." And again, that really reminds me about the situation we're experiencing today. So in terms of the market conditions, just to kind of give you a brief overview of where we are at this point, clearly it's been a strong year for the markets, and that includes the pre and post-election periods. Previous slide, please. Yeah. So in terms of the domestic large cap stocks as measured by the S&P 500 index, they're up by actually over 26% as we speak today, so even slightly better than the performance in 2023. The tech-heavy NASDAQ index is up by over 30% as of today, so it's entirely possible that performance will essentially match what happened, last year. We'll see. We still have 25 days to go. Domestic small cap stocks, they've actually been picking up with large cap stocks over the past couple of months specifically. They're up by over 23% for the year. And again, a lot of that really came from the second part of the year, and specifically the post-election period. Now, developed international and emerging markets are in the positive, as a group, but their performance is certainly not as impressive as for domestic stocks. We have a lot to say about that, and Asi will, unpack it for you as we go forward. In terms of the domestic bonds, is this one is specifically the Barclays Aggregate Bond Index. The bonds are up by only 2% this year as a category, but I like to say that it can be somewhat deceptive in some sense. And what I mean by that, let's say you focused entirely on, let's say, short-term US Treasuries for most of the year. Well, chances are your actual performance for the bond portion of your portfolio would have been, over 4% this year or so. At the same time, if you mostly focused on, longer term bonds for any reason, it's entirely possible that you would actually be in the negative. In terms of the 10-year Treasury yield, something that we pay close attention to because a lot of our clients, they need to maintain a significant portion of their portfolio in bonds. Again, Asi will talk about this in more detail, but the yields are actually up, at least if you compare to the beginning of the year, 4.3% as we speak today. In terms of the sector performance, there's certainly at least one surprise compared to where we were 6 months ago or so. So specifically, financial stocks, they happen to be the best performing sector this year. Again, we'll still have 25 days to go, so we'll see what's going to happen. But a lot of the performance came from the post-election rally. Again, we'll talk about that too. Perhaps no surprises in terms of the tech and communication services sectors. That's in line with the expectation for this year. In terms of the perhaps worst performing sectors, well, healthcare, real estate, and materials are at the bottom. All three are in the positive, so no single sector is in the negative territory, at least as of today, but still there's a significant difference between them. And with that, say, what do you have for us?
Thanks, Alex. Hi, everyone. Thank you for joining us, spending an hour with us to hear our thoughts on the outlook for 2025. As I was telling Alex, like our crystal ball is not any different than anyone else's. We just try to bring a combined 25 years of kind of deep market experience to think about how we would position our client portfolios, both in the coming year, but importantly, as a retirement planning firm on the 5 to 10 year view as well. As Alex was saying, one of the things I didn't have to change in this year-to-date performance was tech. When I last did this in July, it was up about 33%. So there has been, whilst we were talking about the Magnificent Seven, et cetera, tech has slowed down in the second half, with many other sectors really coming to the forefront since then. To set the stage, just some, how we're doing year to date, full year last year. We've heard often US large caps have done much better than small caps. And on a style basis, the growth companies, the tech, the mega caps have done much better than value. And yes, in 2024, it has narrowed. The difference between the large cap and the small cap has narrowed, and the difference between growth and value has narrowed considerably. This is data to October. If you look at the November data, year to date November, it would have narrowed even further. And I think this is a trend that is likely to continue and be durable. 5 year performance, again, same trends, large cap better than small cap, growth over value. And as the rest of the slide deck will show you, there are certain headwinds that large cap and growth present themselves today. Yes, it was the case 6 months ago as well, but there's only so much in terms of how much this outperformance may continue to grow. Quick look at domestic bonds. And I guess the key takeaway is the title line, which says credit spreads are near all-time lows. What does that mean? That basically means if you invest in corporate bonds, the yield increase you get over buying a similar 10-year, say a 2-year US government treasury versus a 2-year corporate bond, you're getting the least amount that you've gotten, least increase in yield you've gotten over a very long historical period. And I guess the key takeaway would be there's less reason to go and own corporate bonds for higher yield, because you're just not getting that bump up that you've gotten historically. We've just circled a couple of areas that are particularly attractive. The tax equivalent yield from municipal bonds are pretty attractive if you're in a high tax bracket. And then the yield curve itself is quite flat. You're getting 4.5% on a 3-month treasury, and you're getting a similar amount if you buy a 20-year bond as well. The economic conditions, just a quick snapshot. I think the key takeaway is, since we last presented in the middle of the year, there has been a notable improvement in growth. Unemployment was, when we last did this, was 4.3% in July. It has now dropped to 4.1%. Growth expectations for 24 have been lifted, and And there's no surprise that bond yields have gone up as well, because the problem with better growth is that inflation has come in higher. Inflation bottomed at about 3.1% in August of this year. This is year on year growth. In October, it was 3.3%. And my bet, especially with all the talk of tariffs, is that the risks are that we do not hit the Fed's target for 2% core inflation, that we stay higher in 2025, even though Wall Street expectations are for inflation to go down. What does that mean for our market outlook? And this is just a kind of a snapshot of the following slides, but and to go through with this, recession really is no longer a discussion. When I did a market update in the mid-year, there was clearly a debate about, hey, is this going to be a soft landing or is it going to be a recession or hard landing? And that was kind of a toss-up. There is very little debate that of a recession, and I kind of agree. And the markets are pricing that. Markets up another 25%. When I say market, S&P 500 was up over 25% last year. It's up 25% this year. Just to keep things in perspective, the longer term return from the S&P 500 is between 7 and 8% annualized. So, these are two dramatically good years. Bond yields have gone up. One of the interesting, there's a slide deck in the appendix if anyone has questions. The 10-year yield has increased the most since the Fed started cutting rates in the last 35 years. What does it mean? I'm not sure, but my guess would be we have so much more debt, we as in the US government, that the behavior of bond yields, it may not be similar to what we've seen in prior cycles. And then that's a theme we will touch on in other slides further down. And I think we can all agree that the full spectrum of Trump's policies and their impact is unknown. Stocks are clearly pricing a bullish view on what these policies will mean. And I agree, right? There's going to be less regulation that's going to be good for growth. But what about the potential for tariff kind of retaliation? There's going to be the prospects for higher inflation. And his policies are definitely going to increase the deficit, meaning we'll have to raise more debt, and the refinancing of the debt is quite sizable. Stock valuations are approaching the 2000 highs, which is definitely a headwind for very long-term returns. Valuations are a strong predictor of 10-year returns. They do not predict the short term, 1, 2, 3 years. So we keep that in mind, and we'll highlight some of the areas where, despite attractive valuations, we are underweight those areas. Finally, deficits are likely to keep interest rates higher, or the ability for the Fed to cut is going to be limited because the US is going to be issuing such a huge amount of debt each year, both to refinance, but also because we're spending about $2 trillion more than we've taken in taxes. The conclusion is, the markets are pricing in very robust growth outlook. We're up 25% this year. The old adage, when markets are greedy, perhaps you should be fearful, be prepared for a divergent outcome. And that's what, Alex and I talk about and try to think through on a daily basis. Quick slide on how the performance has panned out. The outstanding performance, NVIDIA, 184%. The purple line is the Magnificent Seven, up 57% this year, helped largely by NVIDIA. S&P up 27, and as Alex pointed out, the two red lines is emerging markets and EFA, which is kind of developed markets. They're up only 4% and 8.5%. So really quite the laggard, and we'll have more to say about international in the coming slides. No surprise again. I should pause here. I'm going to run through some of these slides really fast. Not too fast, but fast. So if you have questions, please pop them into the chat box. Only Alex and I will see those, and we will respect your privacy when we, ask the questions to the broader audience. A record high inflow in U.S. equity flows, right? That's why the markets are up. You have seen typically when you have these record inflows that the following years aren't as good, and that the money flow does not continue. With the marginal change declining, it can be a headwind for performance. We should also not be surprised that the bulk of that inflow has gone into technology stocks, and the other sectors have received much less. And this, I suspect, provides an opening for a broadening of performance. Right? We know the S&P 500 really has been dragged up by a handful of stocks, 7 to 10. The other 490 have not done much price-wise. So if there were to be a rotation from tech, the other stocks, the 490, could potentially do well, even if the index itself does not do well. So keep, something we think about. Concentration is at a 35-year high. This does not predict future performance. What we can definitely say is that there is less diversification. Just like we've benefited from a few stocks going up, we buy 500 stocks in the index, a handful of stocks could limit the performance of the entire index because of this lack of diversification. Just something to keep in mind. We have benefited, but is this something we need to take on board, thinking about the coming 5 and 10 years? We're seeing early signs of excess, and this particular chart is single stock leverage ETF volumes. And the example I would use is you could go buy an ETF that is only invest in NVIDIA, and it gives you 2 times the returns, and there's another version that gives you 3 times the returns. So if NVIDIA is up 3% today, the 2x version will be up 6%, the 3x version will be up 9% in a single day. This amplifies the return, which is wonderful when things are going up. This is really not an investment vehicle. This is for traders, but you clearly can see it's going to work just the same on the way down. And this is really, to me, a warning, sign that we are seeing some excess taking place. But one of the other factors that you have seen in market peaks is IPO activity. And IPO activity is still pretty benign today. So, there's perhaps a single warning light at the moment, and some of the other areas that we're keeping an eye on is not flashing red yet, but we'll be watching. S&P valuation, there's only been 2 other points in the last 60 years where the valuation, and if you look at the purple line here, which is price to earnings, PE ratio, and the orange line is price to sales. There's only been 2 other points where it was higher, and that was in 2000 at the peak of the dot-com bubble, and in 2021 after the COVID rally. So these are areas that, again, if you're thinking about 10-year returns, most market practitioners will tell you, you should be assuming fairly low. There are plenty out there that will say that you would expect negative returns from the S&P on a 10-year basis because of this high starting valuation. So that was kind of some of the headwinds. But is there a thesis for why stocks should be these valuations? It's justified to have this performance, and that the performance will continue to be robust. And I can easily make a case for that bullish thesis as well. And the next few slides will walk you through that. Profit margins are at all-time highs. And I can easily make the case, hey, Trump's a pro-growth president. His policies are going to maybe support these margins. You could make the case they even go up some more. And that's one reason that we should be willing to pay more for stocks, because the higher margins allow you to get, grow your profits better. US companies, it's this gray area at the bottom part of the slide, return a much larger percentage of their cash flow to shareholders via dividends, and an increasingly large amount through share buybacks. And what that does is it improves returns, not share price returns, but the accounting returns, like return on assets, return on equity, which in turn allow share prices or stocks to trade at higher valuations. And I said, hey, look, valuations are near close to an all-time high, but hey, we've also been returning capital to shareholders, and the returns of the US stocks are much higher than they used to be as well. And the last one is a healthy consumer. The US economy, US GDP, over 70% is consumer or consumption. And so to the extent the US consumer is healthy, we're going to have a very robust base for companies and cash flows to grow. And it was funny because in 6 months ago in this slide deck we showed one of the risks, which was credit card delinquencies rising. And yes, they are at a 12-year high. And so I think it speaks to the two-tiered economy. Overall credit card debt as a percentage of disposable income, which is this chart, or if you put it relative to GDP, is actually quite low. But there is a segment of the population, perhaps the bottom half of the income pie, that's struggling, and you've had delinquencies go up. So not quite a head scratcher. I think both can be right, but I think I would prioritize or value this data here, which is total credit card debt, revolving credit, relative to incomes or relative to GDP. It's fallen. So the overall health of the consumer is very good. We're going to end with a few slides looking at what's attractive. We keep talking about the US being expensive. We've all enjoyed this amazing run by US stocks, and it brings us to international. Both an absolute valuation and especially on a relative valuation, meaning relative value of US stocks, value of international stocks. Emerging markets and developed markets are both very attractive. And we're going to keep a close eye on it. This argument was also accurate 12 months ago and 24 months ago, but they have continued to underperform, and we're going to keep a close eye. We have been underweight. It's worked out so far, but this is perhaps an area that we can allocate to more meaningfully down the road if there is a reason to change. Last one, just a chart of the asset returns over the last decade or two. And with Bitcoin knocking on 100,000, it's, the strong track record, and it just pops out that, for 3 of every 4 years, it's the best performing asset, followed by it's the worst performing asset. We all know it's volatile. It is a relatively short history. It's been around for 15 years, but it's something I suspect, is going to be an increasing conversation. Hey, is this an asset that offers value just like gold in terms of protecting portfolios and providing returns?